First, you must understand how banks create money. Money is created when banks make loans. Banks can loan money to individual people and also businesses. Even though banks have the power to make loans, they are required to keep some of the money they receive in their reserves. The reserves are the cash that the bank keeps on hand, plus the deposits at the Federal Reserve. To determine how much money banks have to keep in the reserves, we use the required reserves. The required reserve is the smallest fraction of deposits that the Federal Reserve requires the banks to hold. It is important to note the difference between assets and liabilities. Assets are what a firm or individual owns. A bank's assets are its loans, vault cash, and its reserves. Liabilities are what a firm or individual owes, or its debt. A bank's liabilities are deposits owed to customers. Not only do bank deposits affect the individual or the firm, but they also affect the economy on a larger scale by means of the money multiplier. The money multiplier determines the amount the money supply increases when an individual or firm makes a deposit. To determine the money multiplier, you use the equation 1 divided by the required reserve. Then you use this outcome and multiply it by the amount of the deposit, and that is how much the money supply is increased by. Next, we are going to learn about the Federal Reserve. The Federal Reserve is a central bank created in 1913 that oversees the banking system and controls monetary policy. Every bank in the U.S. is limited and regulated by the volume of reserves, which is controlled by the Fed. It consists of two parts, the Board of Governors and the 12 regional Federal Reserve banks. The Board of Governors has 7 members that are appointed by the President. Each serves a 14-year term, and there is one chair of the Fed appointed every 4 years. Here are some past Fed chairs. The current chair, Janet Yellen, is the first female Federal Reserve chair and was appointed just recently in February. The 12 regional Federal Reserve banks each represent a banking district. The 12 Federal Reserve districts are Boston, New York, Philadelphia, Cleveland, Richmond, Atlanta, Chicago, St. Louis, Minneapolis, Kansas City, Dallas, and San Francisco. So what does the Fed do all day? The main job of the Fed is to direct monetary policy. Monetary policy is set by the Federal Open Market Committee, or the FOMC. Some other functions are regulating the banking system, lending banks discount reserves, and check clearing. But we'll focus on monetary policy today. Monetary policy deals with the money supply, the sum of deposits inside banks, and the currency in circulation outside banks. There are 3 tools the Fed uses to change the money supply. 1. Reserve requirements. 2. The discount rate and federal funds rate. And 3. Open market operations. The Fed changes reserve requirements by changing the required reserve ratio. If the reserve requirement decreases, banks will have less money in reserves and more money to lend out. Loaning will, as a result, increase the money supply. Alternatively, if the reserve requirement increases, banks will have less money to lend out, so the money supply decreases. The discount rate and federal funds rate are 2 different interest rates. The discount rate is between banks and the Fed, while the federal funds rate is between banks. An increase in these interest rates will discourage lending and borrowing, so the money supply will decrease. If the interest rate decreases, the money supply will increase because trading will be more favorable. Changing the discount and federal funds rate is something the Fed does all the time, and of the 3 tools the Fed uses, this is the one we hear about the most. The last tool is open market operations, which are the buying and selling of bonds by the Fed. To increase the money supply, the Fed will buy bonds. To decrease the money supply, the Fed will sell bonds. Remember, buy bonds equals big bucks. Sell bonds equals small bucks. These tools can be used in times of recession and inflation to change the money supply. In a recession, there is not enough money in the economy, so the Fed would want to increase the money supply. What are some of the things the Fed could do? Well, they could decrease their reserve requirement, decrease interest rates, or buy more bonds. All of these actions would encourage lending and borrowing, thus creating new money in the money supply. What about during times of inflation? How could the Fed decrease the money supply? If the required ratio increases, or if the discount rate increases, banks will trade and borrow less, thus decreasing the money supply. Also, the Fed could sell bonds, which would decrease the money supply. The Fed is constantly working and regulating banks to make sure the economy runs smoothly. By controlling the monetary base, the Fed can exert a powerful influence on both the money supply and the interest rate. Next, we will learn about the money market graph. The opportunity cost of holding money is based on the interest rate. Interest is the fee that borrowers pay to lenders for the use of their funds. Interest rate increases when the opportunity cost of holding money increases because they can gain more money if it is in the bank. The interest rate decreases when the opportunity cost of holding money decreases because they can't gain as much money if it's sitting in the bank. Consumers only want to hold a portion of their financial wealth as money. Money earns no interest, unlike other assets that earn interest. The demand curve for money slopes down because there is a trade-off between the money people want to hold and the interest lost by holding money, known as the opportunity cost. Money gains interest when it sits in the bank, and you lose interest when you hold money. So, the quantity of money demanded depends on the opportunity cost of holding money, known as the interest rate. Shifts in the money demand curve are caused by changes in aggregate price level, real GDP, and technology. Higher income means more spending is occurring, and the increase in transactions increases the demand for money. With GDP, when aggregate demand goes up, the larger the quantity of money they need will increase. Advances in technology tend to reduce the demand for money because less supply is needed for the production of goods. The supply of money is not affected by the change in the interest rate. This is why the money supply curve is a vertical line. The Fed controls this money supply. Equilibrium interest rate occurs when the quantity of money demanded equals the quantity of money supplied. When the Fed changes the money supply, they can then change the interest rate. In an inflation, the Fed will decrease the money supply, which will then increase the interest rate. In a recession, the Fed will increase the money supply, which will then decrease the interest rate. Next, we are going to learn about the loanable funds graph. When displayed on a graph of real interest rate versus quantity of money, we see that there is a basic supply and demand graph. This same graph is known as the loanable funds graph or the loanable funds market, which is the amount of money used in savings and investment for an economy. Savings and investment are primarily affected by the interest rate. For savings, interest rate is directly related and creates a positive slope between the two. This is because as interest rates increase, saving becomes more rewarding, so people invest more. For investment, interest rate is indirectly related and creates a negative slope because the cost of a loan increases as interest rates increase. It is important to know that not all actions will affect the market for loanable funds in the short run. An example of a shift in the market may be something like, income taxes in the US decrease. What effect does this have on the real interest rate in the US? In this case, lower income taxes would allow people to save more money, causing them to have more money available. This would shift the supply curve to the right. A new equilibrium point would then be established at a lower real interest rate. One of the most common shifts of the loanable funds market is the crowding out effect. The crowding out effect occurs when a government runs a budget deficit where it spends more money than it collects, causing the real interest rate to increase and private investment to decrease because it becomes crowded out.